Good morning, everybody, and welcome to our latest webinar regarding domicile changes in the rules. This is with Amy, our ETC tax manager. We will be taking, as usual, questions at the end. So if you'd like to pop them in the Q&A box, we will get around to answering it at the end, like I've mentioned. If we run out of time, don't worry, we'll download all the questions and answer them in the email and send them out when we send out the recording to you all. Thank you. Over to you, Amy.
Thank you, Sarah. Hopefully everyone can hear me okay. Morning, everyone. As Sarah said, I'm Amy. I'm the tax manager at ETC. So today's webinar is going to be slightly different. We have got Andy leading it, but it is pre-recorded due to time differences. And as you're all probably aware, the main focus of the webinar will be with regards to the end of the remittance basis and the recent changes for non-domiciled individuals. So let's get started. And as Sarah said, any questions, feel free to pop them in the chat and we'll deal with them after the recording.
Hello there, my name is Andy Wood. I am a practicing tax barrister, a member ATT CTA and the Society of Trust and Estate Practitioners, and I've been invited by ETC Tax to present this seminar or webinar even, called Every Dog Has Its Day or Century or Two, which is about the abolition of the remittance basis and other tax changes effective from next week around domicile. So in terms of what we're going to look at today, there are a few different areas, but let's start out with I guess an overview or an introduction to the topic. I think it's worth pointing out the historical context and development of the remittance basis of tax and the special regime for non-doms. We don't have it by accident, and regardless of whether you feel it is fair or not, it isn't one of those pesky loopholes. But at the dying end of the 18th century, there was a little man with a big ego throwing his weight around Europe, and his name was Napoleon. I'm sure you've probably heard of him. At the same time, we had William Pitt the Younger at an impossibly young age of 24 as the Prime Minister of the United Kingdom. It wasn't a particularly easy ride for Pitt because King George III was slowly losing his marbles at the time. But basically, in 1799, Pitt introduced for the first time income tax in the UK, which was primarily to pay for his war with the same angry little Frenchman. And at the same time, he also brought in the remittance basis of tax, and that was primarily to help overseas civil servants who might, in today's terminology, be called non-doms. The idea being to provide them with relief from those new taxes in relation to their overseas property. I'm sure at the time, young Pitt didn't realise quite the political football that he was creating, and ultimately a fiscal tightrope that the government, if I'm being diplomatic, is currently trying not to wobble off. So we see some 226 years later, if my math serves me correctly, Jeremy Hunt, first of all, actually announced in the budget last year, 2024, so about a year ago, the abolition of the remittance basis of tax, and more generally, the removal of domicile as a connecting or a main connecting factor for US tax. Perhaps not such a surprise when Rachel Reeves broadly decided to adopt those plans, lock, stock and barrel. So when she flourished the pen at the budget last year to sign the death warrant of the non-dom regime. So let's have a look at domicile. The first slide on there, a rough guide to domicile. So what is domicile? Well, we could spend an awful lot of time discussing domicile, but first of all, you may lose the will to live. And secondly, it's not going to be terribly important going forward, I guess. But perhaps unusually, if we look at the international landscape for tax, domicile does play, or did play, or will play until next week, quite a significant role in a person's tax position. And particularly if we bear in mind that domicile is not a tax construct, it is a concept of general law. And so that's probably the first point to take away, that these changes are not scrapping the general law position for domicile at all. Domicile will continue to have some relevance when it comes to a private client's legal standing. It's just merely that it will have almost no relevance for tax purposes anymore. So domicile will still be important for say the law of succession, and it will actually also have some relevance for double tax treaties as well. But from a UK tax legislative position, it would broadly taking an eraser and rubbing domicile from the record. But domicile, if we look at the authority, I guess, on this type of issue, Mr. Dicey, in his book, Conflicts of Law, says that every person receives at birth a domicile of origin, and a legitimate child born during the lifetime of his father has a domicile of origin in the country in which his father was domiciled at the time of his birth. So I think that's all pretty standard and self-explanatory. If your mother and father are not married, then a domicile of origin is inherited from one's mother. And that domicile of origin, it has to be said, is pretty sticky, it's pretty tenacious, and there must be strong evidence that a domicile of choice has been acquired elsewhere for the domicile of origin to be overtaken. And I don't use the word replace, and it's not just me splitting hairs, because if we use the word replace, it kind of implies that domicile of origin has disappeared somewhere. It never does. It's always there, lying in wait, even if we do establish a domicile of choice somewhere else. It's probably better to think of it as the foundation of a building. It will remain there until somebody takes the trouble to build something on top of it, and that domicile of choice may be the edifice being built on top of that building. And what Dicey says about acquiring a domicile of choice is that every independent person can acquire a domicile of choice by the combination of residence and intention of permanent and indefinite residence. So that means we need two things. Firstly, an intention to reside permanently or indefinitely in a particular place, and also you need to physically reside in that place, and you need both of them at the same time. If one of those elements is missing, then the walls, again, to stretch our analogy even more, the walls on the domicile of choice will come tumbling down, and all you are left with are those original foundations, so the domicile of origin. So this is a double-edged sword. If I am let's say I originate from outside of the UK, I'm born to Indian parents in India, and I come to the UK, my domicile of origin of India will remain in place until such time as I form the intention to remain in the UK, and whilst I physically stay in the UK. And this is why many non-domiciled individuals have been able to live in the UK for decades and still use, in theory, the remittance basis, certainly until they brought in a long stop date back in 2017, because they would argue that they had not formed the intention to stay in the UK, so that could be retiring overseas or something tangible like that. But it is a double-edged sword, because if little old me tried to assert I was, say, domiciled in Spain, say I've gone to live in Spain, but my domicile of origin is in the UK. I should probably point out it's the People's Republic of Yorkshire is my domicile of origin. In order to develop a domicile choice in Spain, I need to both be a resident there, I need to live there, but would also have to have formed an intention and really be able to demonstrate that intention, that I'm going to stay in Spain indefinitely. Because as soon as I come back to the UK, those two requirements are no longer satisfied. Even if I hop over the border and live in France instead, the two factors are no longer satisfied. So my domicile of origin will revert back. So even if I've gone in the fact I've gone to France makes no difference. My domicile of origin in the UK comes back from the dead, as it were. So let's move on. So the hopefully that makes sense. So the April 2025 rule. So it's worth us having a look to see what these favourable rules that are being scrapped actually are. So firstly, we have seen quite a few changes to the non-dom regime over the years. The main ones, certainly that I can remember well, were in 2008, when a remittance basis charge was brought in, so you had to pay for the privilege. And then in 2017, a long stop date was brought in of 15 years. But the rules as they stand at present for an individual, for income tax and capital gains tax purposes, something called the remittance basis may apply. And all that really does is provides the non-dom taxpayer who is elected to the remittance basis to apply, it provides them with the privilege of leaving his or her foreign income and gains overseas without any tax being paid. So it's just an ability to park the funds overseas, because if he or she brings those funds to the UK or otherwise enjoys or uses those funds in the UK, then they will suffer tax to the extent that they are brought back. If it's foreign income, it will suffer income tax. If it's foreign gain, it will suffer capital gains tax. There were special rules if the pot being brought back was a mixed one. But in order to use that remittance basis, one did have to make, and one does have to make an election and potentially pay a fee to use it, called the remittance basis charge, and the amount of that fee depends on how many years one has been resident in the UK. So it ratchets up the longer you've been here. If you've been resident for less than 7 out of the previous 9 tax years, then there is no remittance basis charge. It's essentially a free punt. If you've been in the UK between 7 and 12 tax years, so 7 out of 9 and 12 out of 14 tax years, then the remittance basis charge is 30k. If you have been resident in the UK for more than 12 years, but less than the long stop date of 15 years, then the fee or remittance basis charge was 60k. Prior to 2017, there was another tier which was 17 out of 20 tax years, but that was scrapped back in 2017 when a long stop date was brought in of 15 out of 20 tax years. So once you've been resident for that period of time, you're no longer allowed this privilege, and you're taxed like any other common or garden UK taxpayer. So the taxpayer has always had the flexibility to choose whether or not they paid that charge and elected the remittance basis to apply on a year-on-year basis. So ultimately each year you would simply do a cost-benefit analysis as to whether it made sense. So it's on there still, inheritance tax. So let's have a look at the inheritance tax rules, which is slightly different to income and gain. So before, 2025, IHT primarily looked at a person's domicile position rather than residence. So if you are domiciled in the UK, then you would pay UK inheritance tax on worldwide assets. So subject to any reliefs or exemptions, etc., everything you own in the world is potentially in the net. Whether as a UK domiciled you were resident in the UK at the point of death was not particularly important unless it was accompanied by a valid argument that you were non-UK domiciled. So a non-domiciled and non-deemed domiciled individual up until April 2025 is subject to IHT on UK assets only. Important to note that even if you've never set foot in the UK ever, if you own property in the UK, again subject to reliefs and exemptions, then that will be in the scope of UK IHT. So UK assets, generally speaking, there's always going to be an exposure of some kind there. Since 2017, one has also become deemed domicile for IHT purposes after 15 out of 20 years. Before that, it used to be 17 out of 20 years, but they aligned it with the new long stop date introduced for income and capital gains tax in 2017. So we have one 15-year threshold across the board. Let's look at the pre-2025 rules for trusts. I don't want to go into loads of detail on this today because we can track this back for many years if we wanted. But I would just want to talk briefly about the concept of protected trusts. It was a concept which was brought in 2017. Some notes that accompany this lecture do have some more detail on the pre-2017 position of trusts, if that's something you are looking for. before. So that's a position before 2017. But let's pick up the story between 2017 and the new rules on the 5th of April 2025. The basic position for trusts is that, and we're talking about here about non-resident trusts, really the type of trusts that non-doms would have. For income tax purposes, UK income tax under general principles is likely to be taxable as it arises. From a capital gains tax perspective, a non-resident trust will be outside of the scope of UK capital gains tax under basic principles. That is, except for UK real estate, whether indirect or direct. From 2015 onwards, the jurisdiction of CGT changed with the introduction of non-resident capital gains tax. So that would apply to non-resident trusts as well. But both income tax and capital gains tax positions subject to anti-avoidance rules. And when they introduced the long stop date for income tax and capital gains tax purposes back in 2017, this caused some enormous problems for potentially for non-resident trusts, because a lot of those anti-avoidance provisions didn't apply where you had non-domiciled either settlers or beneficiaries. And of course, with the new long stop date introduced, some of those individuals would suddenly become deemed domiciled as a result of the changes and could affect how those anti-avoidance rules applied. So they brought in the concept of protected trusts. And a protected trust, broadly speaking, is one established by non-domiciled individuals before they became deemed domiciled under the new rules. If they did become subsequently deemed domiciled because of time served in the UK, then the protected trust rules applied to those trusts and gave them a slightly easier ride when it came to the application of the anti-avoidance rules. So I think if we go to slide 7, protected trust and income tax, it sets out what the position was under those rules. If the settler retained an interest, then we can see that any UK income was taxed on an arising basis. If there was non-UK income that wasn't taxed on an arising basis, the transfer of assets abroad rules which apply to settlor, so section 20, was disapplied. If there was no settlor, or it was only non-UK income in the trust, then we move to looking at the beneficiary, and the beneficiary broadly would be taxed on a capital payment or benefit which was coming out of the trust. For capital gains tax purposes, again, depends on whether the settlor retains an interest. So section 86, which usually would be one of the anti-avoidance rules, which applies where you have a settler of a UK resident trust and they retain an interest. For protected trusts, that again is disapplied. There's relief from section 86. So rather than looking at the settlor, we again, as with the income tax rules, are looking at any capital payments or benefits paid to the beneficiaries. And again, it sets out there how they are taxed. A lot more detail in the notes if you want to get into the nitty-gritty, but I don't really want to get too much into the taxation of trust today. It's worth, I guess, just talking very quickly about the IHT position for a trust. We will look at the changes coming in from April, which are broadly around excluded property. But broadly speaking, if you have a non-domiciled settler of a trust, and that trust owns non-UK assets, and that's excluded property and outside the scope of UK inheritance tax, and even if the settlor subsequently became deemed domiciled, then that pre-2025 has no bearing on whether that trust retained its excluded property status. Effectively, under those old rules, it would be outside the scope of UK IHT in perpetuity. In 2017, however, they brought in some changes which said if we have a non-UK trust, and we look all the way down to through various holding companies or whatever may be in there, and we see that the value is related to UK residential property, then we're not going to allow that to be excluded property. So that would always be within the scope of UK IHT from 2017 onwards. But that's all I really want to say about that now. We will come on to those changes later. So how are we doing for time? Bit longer than I anticipated, but let's move into part two. Let's look at the new rules. Firstly, for individuals and then trusts. So the headline is, I guess, for individuals, is that the remittance basis is abolished. So no more remittance basis from the 6th of April going on. It will be there, I guess, for a historic purpose, and again, just from the way self-assessment works, we'll still have to think about it catching up on tax returns. But going forward, as a planning tool, there will be no more remittance basis. We'll then, after individuals, we'll talk about the changes for trusts. On individuals as well, we're going to look at inheritance tax as well. But if the remittance basis is to be sent packing next week, what stands in its place? Well, it's a very good question, but on the day of the announcement, Jeremy Hunt suggested there would be a replacement regime, and that regime, I think almost entirely, with a very, very teeny-weeny tweak, has been adopted by the new Labour government. So firstly, in line with that decision to try and banish domicile from the tax kingdom, it will be replaced by a purely residence-based regime, and that regime will take effect from the 6th of April 2025. Individuals who elect for that regime to apply will be afforded an exemption from tax on their foreign income and gains. That's the first 4 years of tax residence, and it doesn't matter whether they bring that foreign income and gains to the UK or not. It's not stranded offshore. Basically, for that 4 years, you have a free-for-all. You can leave it overseas, or you can bring it into the UK. You can do what you like with it. So I think on the next page, that's just an overview of the FIG regime there. So basically, if you have been outside of the UK for the previous 10 years, and you come and take up residence again in the UK, then for those first 4 years, you will be able to avail yourself of this election. A couple of technical points is that, as I say, there's no separate charge on bringing the funds to the UK. So no tax if on the remittance, but also there's no fee to pay for the regime either. It's important that you do need to opt into it. So again, as with the old regime, you do need to claim it, and you can claim 1 year and not the next. There are some drawbacks. Probably the main one is going to be you lose your personal allowance, and you also lose your capital gains tax annual exemption. There, for anybody, so that's, I think, the basic rule. So newcomer, as we see, coming to the UK, they've been outside of the UK for 10 or more tax years, they become resident. We see there in the first year, so for those first 4 years, they have the FIG regime, and then if they hang around afterwards, they then move into a normal, a rising basis of UK taxation. So that's fairly straightforward. For those people who have recently come to the UK, their 4 years is not refreshed. So here we see somebody who's been resident in the UK for 2022, 23 through to 2024, 25. So they've been here 3 years. They've been using the remittance basis happily for 3 years. The new FIG regime comes in on the 6th of April 2025. They will have 1 year of being able to use the FIG regime, and that is 2025, 2026. For those previous 3 years where they have been using remittance basis, again, the FIG regime doesn't just give them the ability to bring in all that historic income. That historic income will still be subject to the remittance basis, albeit there is a temporary repatriation facility, which I'll come to in a minute, which may help ease the burden there. So there is a compare and contrast. So remittance basis user, so pre 2025, and then the FIG regime there afterwards. But I think we've covered all of those points thus far. So I did mention this thing called a temporary repatriation facility. So as I say, those who have been using the remittance basis in previous years, so up to and including 2024, 2025, then they will have foreign income and gains essentially parked outside the UK. Without the TRF, if they brought them into the UK, then they would pay tax when those funds are remitted. But what the TRF is allowing you to do, or encouraging you maybe, is to bring those funds into the UK. And for the 3 years on the board there, there is effectively a reduced rate of tax for anybody who wants to bring those funds into the UK to spend, invest, and do whatever they want with. As we'll see, there's a lower rate the quicker you do it. So for the first 2 years, it's 12%. And for the final year, 27-28, it is 15%. So yeah, transitional and temporary relief to encourage you to bring some of those warehoused offshore cash into the UK. One other transitional provision is rebasing. So anybody who has been claiming remittance basis in previous years, they can claim relief in some circumstances, and that will allow them to rebase personally held foreign assets. Excuse me. And it's rebasing to perhaps a fairly strange market value, and it's a market value at the 5th of April 2017. Make of that what you will. Excuse me. So to rebase an asset, there are individual requirements and there are asset-related requirements. So the individual has to be or cannot have been UK domiciled or deemed domiciled prior to the 6th of April 2025. And they must have claimed the remittance basis for at least 1 year between 2017-18 and 2024-25. As I say, it's not just the individual that is subject to requirements. The asset also has to satisfy one or 2 points. The first is that the asset needs to be held at the 5th of April 2017, and it needs to be disposed of from the tax year 2025-2026 onwards. The asset also needs to be situated outside of the UK between the 6th of March 2024 and the 5th of April 2025. So let's look at inheritance tax. So, as I say, it's not just about remittance basis. This is a much broader change, and the aim is to remove domicile from the statute book as much as possible. So these changes also remove the sticky goo of domicile when it comes to determining an individual's IHT exposure. And basically what we're doing now is breaking the nexus between domicile and inheritance tax and replacing it with a residence-based system going forward. And the key concept under the new rules will be whether somebody is a long-term UK resident or not. So for IHT purposes, going forward, the world will be divided into 2 people. Either long-term UK residents, who I will call LTRs, and non-long-term UK residents, who I will call non-LTRs. And LTRs will have an exposure to worldwide assets. Non-LTRs will only be subject to IHT on their UK assets. I'm sure you'll probably have noted already, there are clear advantages, therefore, of being non-LTR, certainly in this IHT context. So who's in and who's out? A very good question. So you'll be LTR in a given year if you've been UK resident in 10 or more of the preceding 20 tax years. So a person is going to be LTR with effect from the 6th of April 2025 if they have been UK residents in 10 or more of the tax years between 2005-06 and 2024-2025 inclusive. So I think we've got the most obvious example here on the next slide. Yeah, so this person has been resident in the UK for those prior 10 years. From year 11, they become LTR. And from that 11th year, their exposure to IHT moves from just their UK assets to their worldwide assets. So that's quite a big, potentially, if you've got a lot of overseas assets anyway, could be quite a significant implication. The next slide, so here we see how it works if you've got a bit of a period of non-residence in the middle. As we see, we've got 3 years of non-residence there. So it is from year 14 that the person becomes LTR, because it's a 10 out of 20 year test, not merely looking whether you've been resident in the previous 10 years. So that's really, I think, all I wanted to say on inheritance tax. Clearly, it's a big shift. It's going to be an important shift for expats in particular. There's a separate webinar I'm doing for ETC tax on long-term expats, but clearly you're removing a precarious argument that you're saying that I've been outside the UK a long time, therefore I'm non-domiciled. They're replacing that, which is uncertain and precarious, with a more objective test, which is I have not satisfied me 10 out of 20 residence test, therefore my HT exposure is reduced. I think that's a much more satisfactory position to be in for an expat. So let's look at the trust changes. First of all, income tax and CGT, and then IHT. So we see now, going forward, the protected trust regime from the 6th of April 2025. Remember that regime, which I said, which protected trusts from the worst of the anti-avoidance rules. That has been swept aside. So broadly speaking, you could have a scenario where the settlers of long-standing trusts now become taxable on trust income and gains from the date that they arise. A couple of wrinkles to that position. Firstly, that is only going to be relevant for trusts with UK resident settlers. If a settler is non-UK resident, then for income and CGT purposes, the new rules will not bite. But then if they come to the UK, then that position will change. Secondly, a settlor might be able to avail themselves of the new FIG regime, which I've outlined already. Of course, that's only going to be a temporary reprieve from the new trust rules, so for 4 years when they come to the UK. In addition, a settler might have died, and if they died either before the changes or they died outside of the UK, then it's a bit of a thin silver lining, but those trusts won't be caught either. And finally, where you have got a settler interested trust, they might decide that going forward, it's better for them to exclude themselves from being able to benefit. That could take the pressure off of them in terms of being taxed on a rising basis. Of course, that's looking at it through merely a tax lens. It might not square at all with the original reasons for setting up the trust. But as I say, needs must there. Alternatively, you could look at the investments held by the trust. So, for example, if you have, say, investments which are producing a lot of income, that might end up being taxed on the head of the settlor. You could look at holding those investments through an insurance wrapper, for instance, and that would, because there's roll-up within the wrapper, that should allow at least for a period of time some respite for the settler. But you've got to look at these things, obviously, on a case-by-case basis. Yeah, so I think there was saying we've dealt with the settler. So if we're looking at beneficiaries, is there anything interesting there? Well, yeah, if we've got a beneficiary who is, say, in the UK and claiming the foreign income and gains regime, then they may be able to receive distributions still from a non-UK trust, free of UK income tax and capital gains. If they're non-resident, then those receipts should be untaxed as well. And I think the next slide has a little chart showing I've put there, cut out and keep guides, the new non-UK trust rules. Hopefully that is useful, but summarises the position for settlors if they've retained an interest, if they've excluded themselves, right down at the bottom, and then on the right hand side of the table we've got a summary for beneficiaries as well. So the problem for beneficiaries will be if they're UK residents and not a foreign income and gains exemption claimer, then they may find that they're exposed to tax as well. Owning for time. So overrunning a little bit, but let's look at IHT very quickly for trusts. I think this is an area of change where the bite is very much worse than the bark, and it's the kind of change that's probably really sent non-DOMs over the top and really thinking about whether they can conduct their UK affairs from over in a different jurisdiction. Because even though if somebody's pretty wealthy and you're taking a cut of their future income and capital gains, so a little bit less has been added onto the pile, maybe that can be overlooked if your life is very much settled here and you're part of the community. If somebody then comes along, as were the changes, the prime change between the Conservatives and Labour, if somebody then comes along and says, we're not just going to be taking a skim of your future profits, we're also going to come and gobble up your existing wealth by taxing your trusts, then that perhaps calls for a rethink. And the scrapping of the excluded property trust, excluded property regime as we know it, a broad and beneficial IHT status that applies to the non-UK assets of trusts set up by non-DOMs, is probably pretty significant. So that domicile link is being removed. So the fact that somebody who is non-domiciled has established a trust is no longer relevant for determining whether a trust has excluded property status or not. It's down to whether they are non-LTR at a relevant time. So the trust needs to be settled by somebody who is non-LTR to benefit from excluded property status. But if you note, I didn't say at the time the trust was created, I said at a relevant time. So unlike the old rules where if you create some excluded property, it was pretty much set in stone, under the new rules, it is fluid. So we will continually look at the status of the settlor at a given time. So if I settle a trust, am I a non-LTR? When the 10-year charge comes around, when the 10-year anniversary comes around, what was the LTR status, etc., etc. So it's fluid. We could potentially move in and out of the relevant property. We can move out from being excluded property into the relevant property regime, and then leave the relevant property regime again. And obviously, if anybody's familiar with trusts, if you leave the relevant property regime, then you may have an exit charge. So we've got some pretty serious consequences here. And we also need to think of the 10-year charge as well. So here we have a scenario, I think as an example here. So we have somebody, the IHT status of the settlor of the trust, whilst he's non-LTR, so we see for many, many years the trust is excluded property. At some point, he has become resident in the UK. After 10 years, say, of consecutive tax years residence in the UK, he becomes long-term resident. Then the trust is no longer excluded property. The value potentially falls within his estate, his or her estate, but also whenever the 10-year anniversary of the trust comes around, no longer excluded property, it becomes relevant property. The 10-year charge might bite. He or she then leaves the UK, and then if they've been outside of the UK for 10 years, such that they suddenly become non-LTR again, then we leave the relevant property regime, crystallise an exit charge, and then we're merrily excluded property again. So potentially a trap for settlors of trusts, and implications which could be pretty serious there. The only time actually that the excluded property status or otherwise of a trust is locked in is at the death of the settlor. So if the settlor dies whilst being non-LTR, then that will be locked in as excluded property. So the final point is to make is around the gift with reservation of benefit rules. Historically, the excluded property rules have trumped the gift with reservation rules, meaning that a settlor could retain an interest in excluded property, and it wasn't a gift with reservation. If your trust was established before the budget, so before the 29th October 2024, and no more funds have been added, then that will remain the case for an existing trust, and as long as the settlor remains non-LTR or the settlor is dead. But for new trusts and any additions to old trusts, then that property will fall fairly and squarely in the gift with reservation rule. So again, need to think carefully about whether settlors retain an interest in trust property. So some quite significant changes there, which you may or may not be aware of. So I think that draws me to a conclusion. I think I mentioned that the expats as a separate webinar on these changes. It's not been great what we've talked about here for those affected by the rules. The flip side is there are potentially some attractions of this new regime for expats, but that's for another day and another webinar. In summary, what do I think of these changes? Well, objectively, if we stand back from this, I think there's got to be a benefit in removing domicile from being a primary connector for tax purposes. Residence, particularly with the statutory residence test that we've had for just over a decade, is far more objective when it comes to determining somebody's tax status. So in principle, it's a good thing. But undoubtedly, I think the scrapping of the non-dom regime, it's hard to really get an idea of the behavioural changes. How many people will it really drive out of the UK? Yeah, anecdotally, we've seen suggestions that lots of people will do, but that tends to be data prepared by companies who, let's say, have some skin in the game when it comes to global mobility. I do think that the changes for trusts and inheritance tax are particularly mean-spirited, and for me, I think if I was a very wealthy non-dom, neither of the two, would probably have me reassessing things as my existing wealth was eroded by that. But time will tell, I think, as to whether economically it was a sound move or not. But for me, I'm done. It says any questions on the slide. I'm not sure I can actually take any. This has been recorded sometime in the past by the time you get to look at it. But if you have any queries, send them to the inquiries email on the slide or to Sarah, who organises these things. But for now, thank you very much. Appreciate your time and hope it was useful. Thank you.
Everyone, hopefully you found that helpful. Just before we move on to questions, just wanted to let you guys know about our next upcoming webinar. So just bear with me one moment. Hopefully you can see the new slides on my screen. So the next webinar will be held on the 19th of June at the same time, 10 AM. However, this will only be a half-an-hour webinar. And this will be with regards to tax considerations for landlords and property investors. So that is obviously the end of the webinar with Andy. I'm just going to hand back over to Sarah to deal with any questions we've had through.
Thanks,
Thanks,
Amy
Amy
and
and
Andy.
Andy.
So yeah, a couple of questions. If my client is a resident in 25-26 and qualifies for split year, does this count as their first year of residence for FIG purposes?
Okay, so yes, a split year will count as a year of residence for the 4 years when looking at the FIG regime. So any split year, whether that's in or out, will count towards that 4-year period.
Another question we've got here is, I have a client that returned to the UK during the 23-24 UK tax year after 10 consecutive years of non-residence. When will their first year of residence for FIG purposes be?
Okay, so although the FIG regime started on the 6th of April this year in 2025, you can still be a qualifying resident from the 22-23 tax year onwards. So in this case, the client's first year of residence under the FIG regime would be the 23-24 tax year. That's the year they triggered UK tax residence from again.
Thank you. Another question we've got is overseas workday relief still available, or has that been abolished with domicile being removed?
Yeah, it's still available. There have been some quite significant changes with regards to overseas workday relief. So previously you would have to have been considered a non-domicile in the UK. That would be one of the considerations and conditions when claiming overseas workday relief. However, overseas workday relief is still available under the FIG regime. With domicile now being removed as a connecting factor, it's actually opened it up to be available to more people. So relief will continue to be available for those qualifying employees on qualifying employment income in respect of duties performed outside of the UK. So there are some quite key differences here and changes between the new and the old rules. So I would recommend getting in touch if you need any further support on that, because it can be quite complex. It was complex previously and it still is quite complex, but yeah, we're here to help with that if needed.
Thank you very much, Amy. As Amy mentioned, don't forget our next webinar on the 19th of June. We'll send out the details when we send out the slides in an email in the next couple of days. If you have any more questions, do drop us an email on enquiries@ettctax.co.uk. Thanks everyone for listening. Goodbye.
Thanks everyone. Bye-bye.